First of all, welcome everybody. So today, this is class number 2 with Thor with me. I'll be covering liquidity. I'm sure most of you are familiar with liquidity already. But I want to build you guys into like an advanced market maker model traders, so I need to cover all these before. So let's dive in. What exactly is liquidity? So liquidity is essentially the flow to markets, right? And it is the primary reason behind the market movements, whether it's upside to the upside or to the downside, market moves to seek liquidity, right? To use it as a fuel to move even further or to reverse. The liquidity is the single most important element in ICT concepts because without liquidity, we don't have any information on the data, on the direction narrative and everything, right? Without liquidity, any PD array is basically meaningless. So there are two types of liquidity, as you know, buy-side liquidity above old highs and sell-side liquidity above old lows, right? Buy-side liquidity refers to buy stops, and sell-side liquidity refers to sell stops in the marketplace. So essentially, they are orders residing in the market, right? Market manipulations will always be around the context of liquidity. Like I just told you guys, like without understanding of liquidity, any PDRA, fair value gap, whatever the case is, they are meaningless. If you don't know where the liquidity resides, the fair value gap you're seeing on the 1 minute chart is basically it's gonna burn you alive. So consolidations in small ranges are for only generate the liquidity in the financial markets. So you got to be aware of that. In those conditions, you don't want to trade, and I'll tell you why, and I'll explain it later on this presentation. And every trade in the financial markets must have a counterparty. So whenever you see a buy stop, you know that there'll be also sell orders resting at the old highs, for example, or vice versa. Whenever there is a sell stop, there'll be buy orders residing in the same level. So the first chart example, in here, how you notice liquidity, whether it's a buy side or sell side, is basically if you look at this swing high right there, when or as the market moves lower, we as traders know that there'll be there were short sellers at this high right there, and as the market moves, they put their buy stops rather at this high to secure their positions, right? So essentially, market later on returns back into their positions, but at these lows first, they have a net profit. So the short sellers above this high are in net profit, whether it's unrealized gains or realized gains. But whenever the market moves against their positions and trades above that high, now the same short sellers are in net negative. So they're red now whenever market trades above the old highs. So now their stop losses are engaged with the market, provides liquidity to market to move further, right? So the short sellers above the high put the stop losses there, and that stop loss provides liquidity to the market. And also there are breakout traders who are basically buying the old highs, right? Whenever they get stopped, like this move to the downside, because they'll be using their stop loss, they'll be putting their stop losses below the lows, which creates the sell side of the market, sell side liquidity. And whenever they are also taken out, market moves, right? As market moves, their stop loss engages with the market and provides fuel to the market itself to move, whether to it's upside or downside, whatever the case is, right? Without this information, as especially as an ICT trader, we know there'll be orders residing in above old highs or below old lows, right? In the form of buy stops or buy orders, sell orders, whatever the case is, right? So with this understanding of liquidity, what we do is we essentially target these levels, right? We target the liquidity. When you want to long the market, the indices, let's say, when you want to long, you want to target the buy stops, right? When you're in a long position. So you want to buy the lows. And on the flip side of the coin, if you want to short the market, you want to target the sell side this time, sell side liquidity, which resides in the old lows here in the form of sell stops. So you're essentially targeting the buyers in the market who put their stop losses below the lows. And on the flip side, you're essentially targeting the short sellers, stop losses above the highs. So in this figure, looks slightly better. So the market basically generates liquidity above the old highs first, basically inducing, shorts, longs, whatever the case is, generates liquidity, spends time in a short range before making a move, right? And it makes a move. In this case, it's breaking below, right? Engages with the sell side liquidity. So people who are basically buyers in this consolidation area, they put their stop losses below this low right there, old low, right? In the form of a sell side, sell stops, buy stops, sell stops. Sorry. Um, then market engages with the stops there and uses that as a fuel to run in the opposite direction, basically, right? And preferably as ICT traders, we want to be on site with the market makers. And what they do is they buy the sell stops and sell the buy stops, right? As IC traders, we want to be a buyer at the sell stops level, so sell side liquidity, and target the opposite side of the market, which is the buy side, buy stops, and that's basically our framework as ICT traders. And liquidity comes really important, like it plays really important role in ICT concepts because without the understanding of this whole liquidity concept, there's literally not much to do in the marketplace. That becomes like trading becomes kind of gambling, right? Like these fair value gaps in this price action becomes meaningless because you also have a counterpart over there. You also have a city here, right? Without the understanding of liquidity, you would be confused whether to short the market, long the market, then you'll end up probably like reversing your position whatsoever. So the liquidity type, we have a couple different liquidity types. The first and the most common is basically old highs and old lows. Just as I explained earlier, about old highs, there'll be buy types residing that level here about this high. Once the price moves away from that level, that means we know as ICT traders that there were short sellers at this level, and as it moves, they put their stop losses above that high. And on the other side, at old lows, once the price moves away from an old low, we know that some people were buyers at these lows, and once it moves away from it, that means they move their stop losses below the old low and generate the sell side liquidity, the form of sell side liquidity. The other most common type is equal highs and equal lows. Equal highs and equal lows are they're basically like self-explanatory. Whenever market basically forms swing highs at around similar levels, just like this one right there, like they're close proximity, right? Swing high, another swing high here, and another one to the right side, and they are in a very close proximity. This is what we refer as equal highs, and they tend to be targeted, and it is usually an easy target for the market to trade into, right? Because whenever it comes back above these highs or clocks close proximity and moves away, we know there are short sellers at that level, and they put their stop losses above the highs. And this is also generating liquidity more and more in the form of buy stops, right? And later on, whenever market trades into that level, it uses as a fuel to move in either in the direction of the move or as a retracement. And on the equal lows, same deal. Whenever you see a swing low formation, close proximity to each other, that that that's what we refer as equal lows. There are sell stops residing here. Whenever market comes back into an old low, but without engaging with it, that generates even more liquidity at that low. So this low, equal lows or equal highs, becomes a high probability targets in the context of liquidity. Always be mindful of those levels. Whenever you see an equal lows, for example, you don't want to be a buyer because the chances that the odds are against you in that case. You would rather be a short seller and target the liquidity itself, right? Another type of liquidity is what I call it engineered liquidity. This is basically what I've noticed in the marketplace over the years. Engineered liquidity is basically when the market algorithm generates a liquidity, and this level is usually predetermined. So you could actually anticipate that level, that specific precise level, or if you're trading in the direction of that level, and if you see a rejection, I'll show you what I mean by that. You can collapse your trade, right? You can be content with that profit. Now, typically, we observed engineered liquidity in the range-bound markets. We don't see engineered liquidity as much in a trending market. And price delivery algorithm generates liquidity on both sides, buy side and sell side, and later on, it uses both sides of the liquidity as a fuel to move in the direction of the overall order flow. So let's say if you have a bullish high time frame like daily or weekly, right? On the lower time frame, what usually happens is it generates liquidity by just being range bound, open for accumulation, in a consolidation. And what happens is you'll see it the algorithm engages with the sell side first, and then runs the buy side. So now it collected both sides of the liquidity, and then later on it moves in the direction of the overall order flow. In this case, since daily is bullish, in that direction, in a fast manner, because now it collected the fuel. It has fuel to do so. It usually runs fast after engaging with both sides. Engineer liquidities usually forms at consequent encroachment, or CE, what I call it, of an old wick or a tail. And CE refers to mid-level of low close or high close of candles. So the wicks. Generally, we use this type of liquidity to determine the narrative and understand the real direction and anticipate a range-bound market if it has not established yet. And I'll show you what I mean by that. So in this figure, if you take a look at the lows right there, we have a sell side formation swing low here, sell side, and then we have a swing high here, which forms the buy side, right? But after this swing high formation, once the buy side is confirmed, price moves lower and comes back and doesn't engage with the actual liquidity pool. The sell side does not engage with it, right? It doesn't run, it doesn't collect the fuel here, sell stops. Rather, it stops and reverses at the mid level or CE of this wick, of the sell side's wick, right? It rejects there and runs the buy side. So what this tells us is basically whenever market rejects at a CE, I call it engineered liquidity because this to me is an engineered liquidity, meaning later on, whenever market is ready to reverse and take the actual liquidity pool, it is going to use the swing low as a fuel to rip through the old actual liquidity pool, which is this sell side right there. And on the right hand side, if you look at it, you'll see that whenever it trades into that sell side or low, it just ripped through it with one candle. It's not going back and forth or whatever. So this low is just there to give market fuel to move further, to move faster whenever it comes down. So this formation, whenever you see engineered liquidity, it'll usually come in the form of low resistance liquidity run. And I'll explain what I mean by that later on in this presentation. So if you have any questions about that, just keep it for now. This is buy side example. So market forms a swing high here, which is the liquidity pool itself, the buy side liquidity, and then moves lower, forms another swing low here, which is the sell side liquidity, right? And then moves away from that sell side. If you're watching this kind of price action live, you would think like price wants to engage with the buy side, but in reality, it rejects the CE of the buy side wick. So the actual liquidity pool's mid level gets rejected. Now, once it's rejected and the candle closes outside of it, in this case below, that formation is what I call engineered liquidity. So this high now, this swing high, is an engineered liquidity, and the actual buy side is your real liquidity pool. Now, this buy side should act as a drawn liquidity and should be targeted rather easy. That's how you internalize this kind of price action, right? You wait for a sell side sweep first, and then once it's there, now you can safely target the opposite side of the liquidity, which is the buy side above the engineered liquidity. And you can see it later on, it comes in a low resistance liquidity run kind of price action here. You see like 7 or 10 up close candles until it engages with the buy side liquidity pool. Another liquidity type is, this is my favorite, is time-based liquidity. So time-based liquidity is basically whenever price forms a time-based swing high or a swing low. There's a typo there. Swing low. Those timely formed liquidity pools are called time-based liquidity. So for an example, we have previous month high low, right? We have weekly highs and lows, and we have daily highs and lows, and then we have Asia session high and low, which is called session liquidity. Now we are going lower in the time frames. And we have London session high and low, which is also session liquidity, New York session high and low. And then if I go even further, we have New York morning and afternoon session highs and lows. These are intraday session liquidity. And then there is also New York lunch hour high and low. This is another intraday session liquidity example. And you'll be using the same concepts, the time-based liquidity, for your targets, or you'll be basically waiting for one side to get taken out first to just for you to then later on market will give you an opportunity to target the opposite side of the market. And time-based liquidity is always referred back to, and because of that, in ICT concepts, time-based drawn liquidity is the highest probability targets, whether you're scalping or day trading or swing trading. The same thing times fractal, right? If you're scalping, you'll be focusing on more intraday session liquidities, like morning session or afternoon session highs and lows. And if you're day trading, you'll be more focused on either New York, like session liquidities, or even day and week highs and lows, previous day and previous week. Which is why I love time-based liquidity the most. It gives you literally the highest probability targets. So as an example here for the weekly high and low, if you take a look at this figure here, you see a formation on the week, Monday, Tuesday, Wednesday, Thursday, Friday. The Friday high is your swing high level, which is the buy side liquidity, also previous week's high, right? And on the low here, you have this swing low formation, happened on Wednesday, which forms the sell side liquidity, and this is also what we call, if you're looking at this figure on the daily chart, this is the previous week low. Now what you could expect is, if the market is range bound, you could expect the market algorithm engaging with one side of the market, right? In this case, it raids the previous week low and then rallies against that level into the opposite side of the market, basically previous week high. So in a range bound market, you'll see this kind of price action quite a lot, and that's because we're in a range. It'll be seeking liquidity off both sides, basically seeking destroy profile. It'll be running sell side to buy side or buy side to sell side until it breaks out of the range. And for previous day high and low example here, so this is, I believe, hourly chart. Um, this is, let's say, like Monday, okay? Monday's price action here. So Monday formed the range all the way to the high. You have the buy side here, the swing high formation. The buy side also previous day's high, and at the low, the swing low formation is your sell side target, sell side liquidity, which is previous day low. Again, in a range bound market, you would expect one side of the market getting raided. Once it completes the raid, we would wait for either structure shift or displacement or something like that to target the opposite side of the market, which is buy side in this case, previous day high, and it rallies after the sell side liquidity is taken out. Now, session liquidity, this is one of my favorite type of liquidity, just because I'm more focused in intraday trading or day trading. I like to look at the session liquidity. For sessions, you basically need to look at time-based liquidity in the form of different sessions, like for example, Asia session, London session, and New York session, right? So what usually happens in this type of time-based liquidity is basically Asia forms a range, creates a high and a low. In this case, Asia range is marked in pink faded box right there. It forms a swing high, which is the buy side liquidity, Asia high. And at the low, the swing low formation is the sell side Asia low liquidity. Now, before New York open, in London, during London session, London raids the Asia low, takes it out, and then going into New York session, it builds market maker buy model, so to speak, and runs the opposite side of the market, targets the Asia high. So I would be mindful or be aware of session liquidity, especially in range bound markets. This usually helps a lot. In trending markets, though, most of the time it just engages with one side of the market and just keeps rallying in that direction. Like for example, if this was a trending market, it would have just run the Asia low during London and keeps going low. Would have kept going lower during New York session. And looking at the liquidity and the session liquidity like this, and like creating a framework using it, it could also give you the advantage of anticipating a range bound market. So if let's say you are more focused in the New York session, right? And if you know that we are in a range bound market, you wouldn't be targeting like weekly highs, right? You wouldn't be targeting all-time highs or whatever the case is. You would be more conservative with your partials, with your targets, right? So in terms of that, anticipating the range, it comes really handy, and I would definitely be mindful of session liquidity. If you don't know how to anticipate ranges, this is one way to do it. The second, no, actually not the second. Intraday session liquidity is usually New York AM session or PM session, like highs and lows, or lunch hour in this example. So in this example, during lunch hour, which is in between 12 p.m. to 1 p.m., market formed a range, and that in that range you'll have a swing low, which is your sell side, or lunch sell side, and you'll have a swing high, which is the buy side liquidity, right? And going into afternoon, by using the lunch hour range, swing high and swing low, you could anticipate or trade the opposite direction. So whichever liquidity gets engaged with in the first place, Once it's done, it market completes its objective at in this case the sell side at the low, at the swing low. Now you can safely look for long entries, for example, to target either old highs or lunch high or any buy side target really. This is usually like it doesn't happen as clean. But if you see a ranging market like during lunch hour, definitely be mindful of the lunch hour swing highs and swing lows. If it's not ranging during lunch, be mindful. Now, let's take a look at the delivery algorithm. Let's understand how price delivers. And this is the most important part when it comes to liquidity. Now, there are two types of liquidity runs in the marketplace. First one is high resistance liquidity runs, which we call HRLR also. And the second type is low resistance liquidity runs, LRLR. Now, understanding these concepts, these types is, for me, it is really crucial because it allows you to be flat for the day or the week, whatever the case is, or it'll tell you when you should be trading. So if you take a look on the left, this figure on the left hand side, you'll see I annotated this as a high resistance liquidity run just because here's the thing about high resistance liquidity runs. Now there's a swing high, swing low, and a swing high formation. Okay, price moves away from the sell side, creates the buy side here, and then breaks lower. Right. Whenever you see this kind of price action, so it moves away from that high, goes lower, and then it comes back in the range, right? But before it moves down, if you look at on the before it creates a swing high, you'll see some kind of consolidation or like back and forth price action here, right there, like ranging market here, consolidation. Now, algorithm will require way too much fuel, aka liquidity, to be able to run these lows here, this low right there. And because it is not easy to get down there, just because of this thick price action right there, accumulation, because it's not easy to get down there, market will create some sort of or generate liquidity before running the low. So what will happen is it'll retrace all the way back almost to the high, the buy side, swing high, right? And then slowly grinds back, maybe like chops around here, goes back and forth, back and forth, back and forth, like runs the buy sides, runs the high sides, sell sides, and then later on it sells off. So this price action here generates the liquidity and gives the market fuel to be able to get down to these sell side targets here. And another reason for that being is basically in the bearish market, for this example, the old highs, these highs here, here, right here, it'll be acting as quote unquote support, and to be able to the price will encounter a lot of resistance at the old highs here, and because of that, the sell side run, so drawn liquidities here, it'll come in the form of a high resistance liquidity run. Now, on the other hand, in the low resistance liquidity runs, what you'll see is you will not have a thick price action before you get the dealing range. So say you have sell side here residing, sell stops, and then swing high here, buy stops, right? Once price moves away from the buy stops there, it breaks the structure here, right? It trades below this little consolidation area, targets the sell sides, right? Now that previous range should hold the price. So this previous range should act, quote unquote, as resistance for price. So if it wants to get back up to the highs again, it'll require way too much fuel for the market to get up there because it is going to be encountering a lot of resistance. So it'll just keep going lower and lower using this previous range to seek an old low, old high, old low, or whatever the case is, drawing liquidity, and it'll come in the form of a low resistance liquidity run. But if you see price like going violating the old lows, like it retraces way too much into the range, back in the range, that means the conditions are low first of all, and secondly, it might run the buys here in the form of high resistance liquidity run. So it'll chop around here a little bit, generate liquidity, and use that liquidity to either run the highs or whatever the case is, maybe go lower a little bit, down on the highs, whatever the case is. But in the low resistance liquidity run conditions, what you'll have to see is the old range before the swing high and swing low formation, swing high and swing low formation. After the break lower, you would expect or anticipate that range to cause a resistance for price to keep going lower. So continuation. So whenever you see a price action moving so fast, don't be concerned about that. It is actually better because if you know the draw is even way lower, that means it's gonna run there quick, like rather fastly, like quick, in the form of low resistance liquidity run, which we saw on Friday, and I'll go through those examples later on. So high resistance liquidity runs is basically when algorithmic price delivery has to go through a very thick price action to get back to an old high or old low, right? And we saw this actually today. I'll show that as an example also at the end of this presentation. Markets will have a hard time getting through all of the previous PD arrays to reach its high resistance objective. Like I mentioned earlier, old highs or old lows will act as a support or resistance basically, and market will require a lot more fuel to knock out those old high or high resistance objectives. And because of that, it'll be sideways for a while to generate liquidity. And like I mentioned here, for example, range bound markets. Range bound markets are essentially there just to generate liquidity, provide market fuel to move in the direction or to attack the high resistance objectives. Now, generally, when market has to go through a thick price action to complete an objective, because sometimes the drawn liquidity is above an old high, let's say, and there's a thick price action right below it. But if the drawn liquidity is the high resistance high, it'll usually use a sharp economic event or data release like CPI or FOMC to knock out the dense price action, which happened last week on Wednesday during FOMC minutes. I can take a look at that as well. It basically used FOMC minutes data release to knock out high resistance liquidity, high resistance objectives, high resistance highs. The high resistance liquidity runs are the least probable trading conditions, and because of that, it should be avoided, especially if you're not like seasoned enough. If you don't know how to anticipate high resistance or low resistance liquidity run, you should avoid trading it. That's because price will go back and forth way too much, and it's probably gonna make you emotional. You'll feel like you're riding in a roller coaster or something. And low resistance liquidity runs is when algorithmic price delivery has to run on liquidity that has very little resistance in previous price action. So we won't be seeing like range bound markets beforehand, or you're not gonna see a lot of resistance or like support, whatever the case is. So when we see a market coming from an all high or an all low, and it comes rather sharply or one directional, that usually implies that market is in a low resistance liquidity run conditions, and it's going to be in that condition until it completes its objective. Usually, what I mean by that is the moment until it completes the market maker model. For example, trending markets. Um, and the low resistance liquidity runs are the highest probability trading conditions. If you can't, or if you have a way to anticipate low resistance liquidity runs, you will be making a lot of money. So let's take a look at examples here, which I think you'll understand much better. So here, excuse me. So here, market comes lower, right? And then after it takes out the sell side, it rallies in a very, very fast manner, right? Energetically. Before it rallies, there is this like range bound and like consolidation area here, which is what I call a thick price action. Then it starts retracing, right? So in this case, if market wants to run this old low here below that thick price action, that run on liquidity, that sell side attack, will happen in a high resistance liquidity run formation. And the reason being is that this thick price action will, or let me put it this way, the price, whenever it comes into the old thick price action, it'll encounter a lot of resistance or support here. So to be able to knock out that price action, it'll require much more, like it'll require more fuel to be able to get down there. And in this example, it fails, and because it fails, it starts rallying higher, right? And that price action, like this high here, comes in the form of a high resistance, a low resistance liquidity run, like one directional, bum bum bum, and it's gone, right? And if your anticipation is that market will seek the sell side, the old low here, then you can say, okay, I'm in a high resistance liquidity run condition. I should be mindful of that and trade accordingly, right? But if you were to be bullish in this case, right, you shouldn't be concerned about that. You should just like be looking at the buy sides over there. And if you were to be long here before the one-sided delivery, this expansion, you would know that your stop loss below this old low is secure because of this thick price action. Now, this is an example for low resistance liquidity run. So, price consolidated before making a high, right? Before forming a buy side liquidity, and then after the swing high is there, it just sold off, right? In a very sharp, quick manner. Now, here's the thing. It retraced back into the old range, right? This is the old range, the thick price action, and it retraced all the way back up there. Once it gets there, now that creates a high resistance liquidity run up there if it wants to run the old highs. So let's say the drawn liquidity is the old high here. Because of this thick price action prior, it'll come in a form of a high resistance liquidity run. But if you anticipated a drawn liquidity at the sell sides here, then once the price retraces into the old range, you could expect a low resistance liquidity run on the sell stops and trade accordingly. So it'll be rather like one-sided and move very, very, very quickly. But if it comes back into the range, starts trading above it, then that means the chances are low for the low resistance liquidity run, and the conditions are low probability conditions. Power 3. I want to cover Power 3 in this presentation just because this is also basically forms around liquidity, so I'll cover it pretty fast. So first of all, what is Power 3? So ICD Power 3 is price delivery around liquidity and open high, low, and close of individual candles, whether it's a daily candle or any time frame really. Power of three comes in three phases: accumulation, manipulation, and distribution, and some refer to power of three as PO3 or AMD. You'll see that a lot in Twitter, on Twitter. And having an understanding of power of three gives the trader the power of buying low and selling high, and or avoiding manipulations in the marketplace. And that's the most important part, in my opinion, avoiding manipulations. If you can anticipate a power of three, whether it's intraday trade or swing trade or whatever the case is, you as a trader have to have an understanding of manipulations so you could avoid it. Because sometimes you'll end up getting stopped out because you didn't anticipate the manipulation, and that market moves in the direction of your position, but you're already stopped out, right? And it usually tilts us. You need to avoid that, right? And that will come with understanding of power of three. So power of three is basically, like I said, it comes in three phases: accumulation phase, which is a range bound market, basically accumulates, consolidates, generates liquidity above the market price and below the market price. And then manipulation phase basically seeks the liquidity in the opposite direction of the drawn liquidity, and then it starts rallying, engages with the opposite side of the liquidity of the accumulation phase first, and uses that liquidity on both sides of the liquidity actually in the accumulation phase to get to knock out the drawn liquidity in the and that's called the distribution phase. And distribution phase is usually comes in the form of a low resistance liquidity run. You want to be trading in that phase, or like the best case scenario, if you're good with this, you could be trading executing in manipulation phase. That is the best case scenario, and you would rather want to be entering in a manipulation phase. But sometimes you'll miss that, and entering in a distribution phase, entering a position in a distribution phase is also just fine. So accumulation phase, like I just mentioned, in a consolidation, in this accumulation range bound market, the the reason of this is essentially generating liquidity. So whenever you see a range bound market, you'll have buy stops above the highs and you'll have sell stops below the lows, right? This will give the market the fuel to move the price. So before making a directional move, price accumulates and consolidates within a small range to generate liquidity. And during this phase, it's usually where the smart money accumulates their positions, right? They will be entering their positions, whether it's a long position or a short position. They'll be accumulating, constantly entering positions. And then you'll have a manipulation phase. And in the manipulation phase, it basically refers the initial breakout from the accumulation range, and it'll be the fake move. This is when market algorithm makes the move with the intention to seek liquidity, meaning trapping breakout traders and late short sellers or late long buyers, depending on the drawn liquidity. And later, once generated liquidity is engaged, price turns back to accumulation range rather sharply to go in its true direction. And each individual candle also have its own PO3, power of 3. So the general rule of thumb is for up close candles, any move below its open price is the manipulation phase, and down close candles, any move above open price is the manipulation within the candle itself. And it happens on any time frame. So that candle can be a daily time frame, daily candle, weekly candle, hourly candle, even 1 minute candle. They all have power of 3 in itself on the candles. So manipulation phase for the figure, as you can see here, it range bounds for a while. The price is range bound, generating liquidity, buy side liquidity, sell side liquidity. Let's say in this case we have an old high. Let's say all time highs is the drawn liquidity. So before market moves into the all-time high direction, that direction, just because it consolidated before, it'll it will basically seek the liquidity of both sides of this accumulation. So first, it usually seeks the sell side, which is what we refer to manipulation because the drawn liquidity is higher. Then once the manipulation phase is completed, you'll usually see an SMT divergence here at the lows. It runs the highs. So now it'll engage with the accumulation buy side here. And then it'll use this buy side buy stops and sell stops as a fuel to keep going higher. Now there are also going to be breakout traders. So whenever price breaks out from this range, there'll be some short sellers here as well, and then there'll be newly introduced or like Instagram traders who are basically shorting or longing every fair value gap. They'll be shorting this. There'll be a fair value gap in this manipulation phase, and they'll be shorting that fair value gap, and they'll also be liquidity to the market and give the opportunity to market to go up to the upside in the direction of the actual drawn liquidity. And the last phase is the distribution phase. Distribution phase usually refers to the market when it's moving in a direction of its true drawn liquidity. In this phase, further price manipulations is not expected, so you don't have to be worried about more manipulations. If you're using old lows or old highs for your stop losses, they should be safe in these phases. In the distribution phase, because market collects opposite side of liquidity at once, and distribution phases usually comes fast and energetic because of that. An individual candle example, for up close candles, price moves above its open whenever it moves above its open price, or for down close candles, whenever price moves below its open price is the distribution phase. Sometimes I feel like I'm just still muted, or I'm not recording, or I'm not sharing my screen. Sometimes I feel like that's why I'm checking a lot. 'Cause it happened before when I was recording my YouTube videos, I forgot to turn on my mic. It sucks. It's a very bad feeling. Anyways, so individual candle examples here. Let's say we have a down close candle. This red indicates down close, and the green indicates up close candle. So in each candle, you'll have open, high, low, and close, right? So we have an open at this body up there, a high wick, then price moves lower, all the way to this wick low, and retraces a little bit and closes the candle right there. So from the open to close out the candle, it is, in fact, you can also take the low. It is what we call the distribution phase. And for down close candles, anytime price moves above its open price, that is usually the manipulation. So whenever you're seeing down close candles, or you're expecting a down close candle, but it's moving higher first, that is usually the manipulation, and you should be seeking, preferably seeking positions in the manipulation leg. If you can't do that just yet, that is fine. It's not an easy task to do, but you'll get there by time. Anyways, on the up close candles, the green one on the right hand side. So there's the high, the wick, the close, and then open. So price opens, manipulates lower first before going higher. Then it distributes, expands higher, creates a high, and retraces back into a range and closes the price there. So from open to low to its low is the manipulation phase, and the expansion from open to high is the distribution. By knowing this, you could anticipate using daily candle swing positions, or you could try to be a buyer below open if you're bullish, right? Or if you're bearish, you you could try to sell short above its open price by looking at the daily candle itself. But also you can use that information intraday, which is I'll show you. There was a great example today, which I was covering in the general chat. I'll show you that example. So first example here, we have equal highs, right? Buy stops resting above it, drawn liquidity. The price accumulates, range bound, goes back and forth, generates liquidity here at the highs, buy stops, and at the lows, there will be sell stops. And it moves, breaks out of the range to the downside, right? Spends time a little bit, and sharply returns back into range first, and then rallies in the direction of the drawn liquidity. So what happens here is basically the accumulation is the range, breakout is manipulation, and the move in the direction of the drawn liquidity is the distribution. This is why it is really important to have a drawn liquidity before putting any trades on in the marketplace. If you don't know the drawn liquidity, this could be anything. This could be an accumulation. Maybe this high is manipulation, and now you could see this lower price action as a distribution. But that's not the case. If you don't have the drawn liquidity, there's no context. There's no story behind anything, right? So what happens here is price generates liquidity buy side and the sell side, raids the sell side first, spends time, traps shorts here. Breakout traders are getting trapped here, and sometimes smart money is also getting trapped here. Then it rallies, turns against them, and it never gives them an opportunity to close their positions at a break even. That's why it is important to annotate or anticipate trapped positions, because you'll have buyers getting stopped, breakout traders getting stopped, some smart money concept traders getting stopped also, and rallies, and engages with both sides of the market, which is why distribution phase is usually faster. It takes sell side here, buy side later on, uses both sides to move faster in the direction of drawn liquidity. Another example, this is candle basis, and I am showcasing a silver bullet here specifically because that's the trading model, or execution model rather, I like the most, and I'll show you my thought process behind it. You'll see it better in here. So initially price moved away from a range here, probably moved away, formed a fair value gap on the high, upper fair value gap, then there's another second fair value gap on the lower side, right? Now silver bullet, there is a time, it's basically time-based delivery, right? Silver bullet means delivery within 10 a.m. to 11 a.m. in the morning. That's your morning session silver bullet. And it usually gives the opportunity for us to utilize fair value gaps. So I refer silver bullet as silver bullet fair value gaps. Now I annotated the 10 a.m. candle open here. So candle 10 a.m. Think about hour in terms of hourly candle here, right? 10 a.m. open. Now it retraces into silver bullet. That is your manipulation. It is forming a high for a down close candle. So you're expecting or anticipating a down close candle, right? Opens, candle opens, retraces. This is your manipulation, right? Into the silver bullet fair value gap. Now you're selling short in a manipulation phase. So that is a high probability fair value gap for you. And then it comes back into the range, accumulates here, manipulates one more time, and then once it breaks out of the accumulation area and breaks below the candle open, now it set the stage for the distribution, right? Once it breaks out the range, retrace back there, and then keeps going lower and lower. This is your distribution, and 11 a.m. candle closes right about there. So you're selling short the manipulation. The last resort, what you could do is you should be looking at the candle open, for your entry levels. Anything below that, you should be entering. Think of this like equilibrium of a dealing range, basics, so to speak. Um, so silver bullet is essentially a manipulation on the hourly candle. The importance of silver bullet is, I mentioned this a couple times before. So at 10 a.m., couple things happen, right? You have a 1 minute candle open, you have a 5 minute candle open, 15-minute opens, 1 hour opens, and 4 hourly opens. They open simultaneously, right? That's why price moves um, like fast, energetically. You have five significant candle open simultaneously. So you're essentially shorting or buying their manipulation phase. If you're seeing price retracing into a silver bullet fair value gap after 10 a.m., beautiful. You have a manipulation there. Short that or buy that, whatever the case is. But again, to be able to do this, you need to have drawn liquidity. You need to have a context. As an ICT trader, or as ICT traders, the most important thing is buying or selling the manipulation. If you can't do it, try to do it at around price open level. Let's see what else. Okay, trading exercise. Before I get into trading exercise, I'm gonna stop here for a second. Oh, hold on. Give me 1 second here. I actually want to go over a couple of things here. First thing, I'm gonna go over the high resistance, low resistance liquidity runs, because it is, in my opinion, really, really important. And today was a great example for that, so I want to go over that real quick. So as you might know, I anticipated a high resistance liquidity run about this high here, and that high is because it is essentially a consolidation. Okay, here, I'll annotate that as an original consolidation, okay, because that was the thought process behind the anticipation. So I anticipated all this move in the form of a high resistance liquidity run. Let me pull the dealing range also. So we have a dealing range from original consolidation high all the way down to the smart money reversal area, these lows, right? So I'll zoom out. We have the market maker buy model. We have drawn liquidity here. And then if you look at the previous price action, there's a consolidation, thick price action here, right? Price rallies, sells off. Once it breaks away or moves away from the previous range, thick price action, this comes in the form of a low resistance liquidity run, right? And now it traded back into that range, right? And at open, somewhere here, we were respecting the equilibrium of the dealing range, right about there. So New York open somewhere there, respecting the equilibrium of the range, the drawn liquidity here, and the drawn liquidity is actually within this thick price action prior to sell off, or like slightly above. So price has to go above this old range to get into to knock out this buy side. Oh, what am I doing? To attack to knock out this buy side drawn liquidity objective. And that is how I anticipated a high resistance liquidity run there, because of this previous range, thick price action. This means whenever price trades into that old range, it is encountering a lot of resistance at old highs, old lows, and all those levels. And knowing today is going to be a high resistance liquidity run, you can literally do two things. You can either be content with conservative targets, right, if you want to trade, or your second option is just sit through this day, wait for low resistance liquidity run conditions, right? And that is why it's really important to be able to do these kind of anticipations. Hope it makes sense. If you have any questions about that, ask me right now before I move on. About high resistance or low resistance. Now let me show you an example of low resistance liquid run as well. Liquidity run. For example, on Friday, actually let me not go over that here. Thick price action forms a higher high, then it violates this old range, trades lower. Once it trades lower, let's say you want to target these lows right there, right? If that's the drawn liquidity, it shouldn't be trading back into that range. If it does so, then the odds are against you. It means it's going to be low resistance liquidity run into the buy side here, or it's not going to engage with the sell side maybe later on or something like that. But this way you can anticipate low resistance liquidity runs. However, you gotta be able to anticipate a drawn liquidity first. Once you have that down, let's say in this case that low, just because this is kind of like consolidation area on a lower time frame. Like if I pull 15-minute up, you'll see it better. So this is an original consolidation. You have a low sell side target right there, right? Once this range is traded outside, so once this range is once price moves away from it, now you are in a market maker sell model, and as long as you stay below this old range, it should be a low resistance liquidity into the drawn liquidity. Until it engages with that liquidity pool, it is not going to reverse back on you. That's it. It is not going to reverse back on you. You gotta trust that. And that is the anticipation of low resistance liquidity runs. And later on, it rated the high here, right there. But as I mentioned in the presentation, usually whenever price wants to run the high resistance objectives, in this case high resistance highs, right? Every high you see here, the high resistance buy side objective. If price wants to run those highs, it'll usually use a news driver. In this case, it was FOMC minutes. So, any questions about high resistance and low resistance liquidity runs before I move on? This is very, very important. Alright, no questions, I assume. Cool. So, one more thing I'll show you guys from today before I move back to the presentation. This is about power of three by individual candle basis. So, as mentioned earlier, the drawn liquidity, the anticipation was the high at 18,064. I'm going to zoom in on the hourly. 9, 10, 11 candle here. Let me go back to that candle. Now I want to see price running that high on the 1 minute, right before 11 candle opens. My anticipation was basically power of 3 based on 11 a.m. candle on the hourly chart, right? Once it opened, this is 11 o'clock. Now you have an open level, which is about this. 11 a.m. open. Hourly candle open. Now what I'm expecting is, because we are in a high resistance liquidity run conditions, and because I want to see, or I anticipate price is being drawn into a buy side target, I want to be long in or below 11 a.m. open, which is basically power of 3 on a candle basis. So I want to see something like, so I'm anticipating something like this. Accumulation here a little bit, manipulation phase, and then distribution into the drawn liquidity, right? and I want to be a buyer anywhere here. Anywhere below 11 a.m. open, I want to be a buyer. Because once that candle distributes and closes, then you can use 11 a.m. open as your stop loss and it'll be in profit. So the high probability and the safest way to enter a position is below open price if you're long and above open price if you're short. So moving further, let me go to 11 or 12 p.m. Here's 12. Right about. There should be a big candle. Okay, there you go. So this is 11 open. This is where it closes. That candle. My hourly candle close. Now think about in terms of power of 3, right? You're anticipating power of 3 in an individual candle, which is the hourly candle here. What you have is there's like an accumulation here, right? And anytime price moves below its open price, this area is the manipulation. Let me make it a bit cleaner though, just for the sake of this conversation. So anytime it moves below the open price, that's the manipulation. And once it breaks above this range high, it should start the distribution phase. So I was anticipating that hourly candle delivery in the form of distribution to the drawn liquidity. So let me put it this way. Let me change the color. I don't like these colors. So this is accumulation, manipulation. Now the candle is red, but you're anticipating an up close candle, and then it distributes to the higher. It didn't engage with the drawn liquidity I was anticipating, but it's a generous delivery if you think about it, especially since because we are in high resistance liquidity run. So yeah, anytime it comes down below the open price, you would like to be accumulating long positions with on side with the market makers basically. And in this case, what it was doing is, so we have the silver bullet here. It was actually trading into silver bullet fair value gap, and also on the bigger picture, the dealing range here. If I pull the CE, so anything below that CE is discount. It was actually giving a couple more opportunities to market makers to long that position in a discount PD array. So I would consider this as a clean price action. However, it didn't engage with the buy side. That's fine. It happens. If you're seasoned, or if you're ICT himself, you can basically like long use these wicks as a long position, like pyramid your positions. That's not what I would do because I don't like to sit the entire day behind the charts, but you know, definitely doable. Can you draw the 10 a.m. open? Of course. I'll take a look at what you just asked, Kila. Give me 1 second. Let me just do the 10 a.m. AMD first. So 10 a.m. opens there. This is 10 a.m. open. So anytime it spends time below that level is the manipulation essentially. Here is the manipulation. And then it just distributed. On the microsecond charts, you'll probably see the cleaner where it accumulates and then manipulates and distributes. So this fair value gap here, the silver bullet fair value gap, is not in manipulation phase of the candles, but it is still a high probability fair value gap just because the manipulation is just completed, first of all, and the second of all, and secondly, if you look at the New York Open, that is your Judas swing. We have a south side here. The manipulation in the bigger picture has already been completed. So you don't necessarily have to have a fair value gap below the open here as a silver bullet to go long. 'Cause on the 50-minute, you'll see it better. Yeah, come on. So on the 15-minute, what happens is this low is getting rated into a PD area here, fair value gap, right? It's respecting there already. And in terms of the range, it's trading into the discount and taking out the lows here. So on the 1 minute basis, you don't necessarily have to have a manipulation into a silver bullet fair value gap. Because essentially this is, here I'll tell you. Here I'll show you why I would trust this fair value gap on the 1 minute. So this was the sell side, the range equilibrium. First things first, it is below range equilibrium. So you are literally longing the discount, in the discount. That's the first thing. And second thing, there is an order block here. So anything above that order block should have been a breakaway gaps, or it shouldn't have traded into. Because it did so, now you have a change in the state of the delivery. You can safely look for long entries and put your stop loss either here. That might wake you out though. It's not like as safe, or this up down close candle. If it makes sense. That's why I would I forgot the word. I would trust this fair value gap. Silver bullet. For high resistance liquidity runs, can we use a breaker to see how price reacted to the tick price action, and if price not reaching, well, we can expect a high resistance liquidity run. So here's the thing about that. That's a great question. I'm going to pull that price action again. Where was it? Here. So preferably, if you want to see like really fast market, it shouldn't even come back into the range. As you can see here, it moves away and never comes back. It never tests this low, right? I'm not looking at here in this price action, I'm looking at the first swing. So preferably it shouldn't even touch there. If it does so, because sometimes the PD areas will allow it, so you're not going to see this order block here. It's going to be a down close candle, so you'll have a couple fair value gaps. In that case, it could come back into the range. However, it should react to the range low very sharply. It shouldn't like go into the range. Because if it does go into the range, then odds are against you. It'll probably just chop around a little bit, generate liquidity. And then what depends on the high time frame order flow, it'll either use that generate liquidity to run the high resistance objective, or just manipulate a couple times here and to keep going lower. If that makes sense. So for your question, if you don't see an order block before the breaker block here in the range, yes, you can anticipate, you can use, or you can see how it's reacting to that breaker block. It shouldn't violate that breaker. But if you have an order block, like this example, it shouldn't come up there. Here, as another example here, you see how it's moving away right away before getting back into range? That sets the stage for a low resistance liquidity run. Like for example, let me find an example here somewhere. Look at this price action. Like sell side there, right? Then you have a swing high there. The dealing range from the low to high. Now the dense price action is at these lows, right? Meaning price will require a lot from the market in terms of liquidity to be able to get down there. And before rating that low, you see how price is moving. It's basically like going back and forth within discount and premium, generating liquidity. Like too much equilibrium action as well here. Too much equilibrium action, too much back and forth, right? That's another signature. That's also how you could anticipate a high resistance liquidity run. This low, as an objective, is a high resistance liquidity run for the market to get through. To be able to knock out that level, it needs to generate liquidity first. What I mean by generating liquidity is basically every high and low you see in this range bound price action is generating liquidity, providing liquidity to the market. Here, there, there. You see like sell side is taken out, now it's turning back. Here it forms a swing high, swing low, then takes out the sell side, comes back. You see what I'm saying? Like typical high resistance liquidity run. Again though, you gotta have a drawn liquidity. You need to know how to find drawn liquidity in the marketplace. This is very important stuff, guys. Like, I'm talking about high resistance and low resistance liquidity runs because, like I said, it is very important. And I don't think a lot of people know how to anticipate that. Wait, so I know Tanya is not bad. Tanya is good about anticipating this also. I don't know her thought process, but this is basically how I personally internalize it. So yeah, guys, any questions before I move on to the exercises? Fabio, do you have any questions or do you want to add anything? Or are you even here? Oh, you're not in the speakers. Never mind. And never mind. All right, let me get back to the presentation. So this week's exercise, it is very fun. This is very fun. All right. Shout out to Fabio for the idea. It's his idea. So this week for this week's exercise, what I want you to do at the end of each trading session this week, from Tuesday through Friday, I want you to watch the live price action, right, live, and explain why low resistance liquidity runs or high resistance runs happened. If you want to annotate it on the chart, show it on the chart. But you got to be able to think in terms of market maker's perspective to be able to do so. And think about why it is a low resistance liquidity run or a high resistance liquidity run. You can use any time frame for this. And I want to see your charts like showcasing your, or like, how can I put this down? Showcasing how you internalized it. You know what I mean? I want to see how you think when you see that kind of price action, if that makes sense. But I want you to do it during live sessions by watching um, live price action, because it is harder at the end of the day to do it during live. Like whenever you're seeing candles printing, you'll be thinking like, oh my god, this is an up close candle because it's moving higher. Then before it closes like 20 handles below its open price. You know what I mean? So it kind of fucks up with your thought process when you see it live. Whereas if you're doing in hindsight, it's a bit easier. If you can't do it during live session because you're working or something else, uh, just you can do it after each session in the hindsight also. I'm okay with that because I know some folks are just they're working and they can't watch price live from their computers. But yeah, I'm gonna post this also in the exercises channel. This should be fun. I love how practical this exercise is, and I'm very excited to see your charts. So yeah, guys, thanks for coming by as always. If you have any questions, ask it right now, before I wrap it up. Thank you for coming by. I really appreciate that. I would definitely recommend you guys to rewatch this stream, especially where I'm talking about low resistance and high resistance liquidity runs. Um, can we say that the draw and liquidity kick in when a swing high and swing low form? Then our eye should be citing market maker model or zone consolidation for exactly. So for the highest probably, I was having a conversation with Killer Whale earlier today about this, so I'm gonna just talk about that to answer your question. So in today's price action on 5 minutes, let me go on the 5 minute. So he was asking me about the dealing range, and I said the dealing range is from here, the horizontal consolidation, to this low, just because this high is the highest probability drawn liquidity because of the consolidation. But the true range in this price action is from all the way to Friday's high to the low, where smart money reversal happened overnight, right? This is the true dealing range. But if you want to be trading into highest probability conditions, you don't necessarily have to look at the whole range here because you know the price is not going to seek the high resistance buy side objective, right? It's going to go at least step by step. So from the horizontal consolidation high to the smart money reversal lows, you have the dealing range and you target that. So back to your question, TJ. Just like you mentioned, you can target every high and low, right? So by looking at this price here, you can target this low, you can target a high, you can target this high, you can target this high, because essentially they're also buy side liquidity. Above those highs, there's buy stops residing. But if you want to, these are scalp positions. But if you want to trade the whole market maker model, what you'll need to look at is basically original consolidation. And if you're in a buy model, original consolidation high is your highest drawn liquidity, highest probability drawn liquidity. But there's nothing wrong with taking partials above these single highs here also. Like you can take partial here, put your stop loss at break even and send the rest or keep the rest for the original consolidation drawn liquidity if you want to. That's totally up to you. There's nothing wrong with any kind of executions really. It depends on the personality of the trader. I hope that answered your question. When liquidity is engineered, is it typically on the opposite side of the order flow, or can it go both ways? It really could go. It really can do both ways. Um, but the highest probability. Okay, here's the thing. I'm gonna show you an example for that if I can find one. So let me try to find one example. This is a really great way to look at that kind of price action. Mm, maybe this. Yeah, here it's rejecting. Okay. So let's say in this price action, you know the order flow on the higher time frame is lower, right? Maybe you have daily or 4 hourly drawn liquidity on the sell side of the curve, right? Whenever you see a rejection at the CEO of the wick at the highs here, that is your turtle soup entry. Just because the higher time frame order flow is bearish. Now, because of that, that doesn't mean you'll see engineered liquidity only at highs. It'll also be on the lows as well. Maybe I can find an example somewhere. But if you see it on the lows, it's even better. Why? Because let's say, let me do this, delete that, delete that. Let's say here, it's rejecting, so this low later on comes down into a sell side, never engages with that level, and then moves away from it, right? Once it moves away, two things can happen. It is either going to retrace into a premium array, right? Or it's gonna seek buy side first to get lower later on, right? If you have a higher time frame or the flow bearish, what you could do if price were to trade above this high here, you could anticipate a turtle soup event there or here somewhere. Depends on the PA and the time. That's the best part about this stuff. It could happen either way, but if you know the higher time frame is bearish and if you have an engineered liquidity on the south side of the curve, on the south stops, then whenever it trades above old highs, you can turtle soup that. You gotta trust that it wants to rally and attack the easy south side target out. Does that make sense? Perfect. All right. Um, I guess that's it for today. I think no one has any questions. All right, yeah. Let me stop.